really excited today because we have our friends and partners with Fidelity hosting the call to give us a deep dive into the latest Building Financial Futures quarterly findings. It's my pleasure to introduce Mike Shamrell, Fidelity's VP Thought Leadership, but we also have Christine Sanford, Fidelity's Key Account Manager, on the call as well.
Great. Thank you, Leah. As Leah said, hello, everyone. My name is Christine Sanford, and I am in National Accounts on the workplace investing side or record-keeping side of Fidelity. I want to say a quick thank you to Leah and Jesse and Nick and all of our partners in the home office of RPAG for giving us the opportunity to spend some time with you today. We truly appreciate the partnership that we have with RPAG. And I especially want to thank all of you, the RPAG member advisors or teammates who joined today to listen to our presentation and give us some of your valuable time. I'm going to turn the meeting over to my colleague, Mike, in a minute, but first wanted to give him a quick introduction and provide you with a little bit more background on Mike, who has more than 25 years of experience in financial services and technology industries. And he's currently part of Fidelity's thought leadership team, where he helps identify and analyze industry trends and developments in the retirement employee benefits space. Today, he'll be sharing the latest insights from our Building Financial Futures report. Hopefully, you've heard of this report in the past, but if not, this is a long-standing report that's evolved over time that Fidelity puts out, and it analyzes retirement savings trends and behaviors from plan level to participant level accounts we record keep. So the goal for today really is to provide you with the most current trends we're seeing, and for this report to be another resource that you can leverage to help support the conversations that you're having with your clients. I think Leah had already mentioned this, but please send in any and all questions through the chat Q&A function, and then those will be answered following the formal comments that Mike will have. So with that, I will go ahead and turn it over to you, Mike.
Great. Thanks, Christine, and thanks, Leah, for the invitation. Happy to be with everyone today. As Christine mentioned, I'm part of the thought leadership team here at Fidelity, and what my team generally tries to do is identify, we try to take a forward-looking approach and identify trends and developments across the benefits industry in the hopes that that insight will help our clients with their decision-making around their overall benefits program and their retirement plan. This particular analysis that we're going to be discussing today is a little bit more of a state of the state, what the current retirement landscape looks like. And so hopefully it'll provide some insight again on what we're seeing in terms of participant behavior, plan design, and just overall trends and whatnot across the benefits landscape. So before we get into the numbers, I thought we could look at how the whole Building Financial Futures has evolved. So if you go back to when I started at Fidelity way back in 2006, we used to do a report called Building Futures. It was once a year. It was hard copy, and we mailed it out to our business partners and our external audiences. And at that point in time, that was fine, even though by the time this hard copy report arrived, the data was already 6 months old. Then 2008, 2009 comes along, and a growing percentage of the population begins to understand that their retirement savings is tied to this thing called a 401k, which is tied to the stock market. And so we just started getting an avalanche of requests for updates on retirement savings data, plan design, participant behavior. It was at one point where we were getting calls about how much the average retirement account balance had dropped that week. So what we did is we took a step back and said, okay, we're going to do this on a quarterly basis. We thought that would be a good cadence to keep the industry updated on what we were seeing across our platform. And it originally started out as an analysis of our 401k platform, but over the years, we've expanded it to include insight on our 403b platform, which for those of you who don't know, that is basically a very similar workplace savings model, but for the nonprofit industry. So if you think about charities, nonprofit universities, nonprofit hospitals and healthcare organizations, that is a bulk of our 403b's business, as well as weaving in some details on our IRA business. While that is not a workplace savings plan, we do have a lot of people across our platform who are saving in both a workplace savings plan and an IRA. So we provide a little bit of insight on IRAs to add to the metrics that we have for our 401k and 403b business. Over the past couple of years, in addition to 401k, 403b, and IRA data, we've tried to weave in, where applicable, a little bit of sentiment data. So we do a lot of research trying to determine what plan sponsors and participants are worried about, what they're focused on. And if we take that and layer it on top of some of the metrics, we think all of those components really give a complete view of what's going on across the retirement and benefits landscape. In addition, if you add up our 401k, 403b, and IRA platform, it's a little north of 40 million accounts. So we just think that sample size in and of itself provides a pretty accurate indication of what's going on across the retirement landscape and trends and developments that people should pay attention to. So that's a little bit of background on the actual report. Now we want to go ahead and jump into highlights for the quarter. So again, our most recent data is Q2. So this is as of June 30th, but here are some of the highlights that we called out for Q2. Going back to the discussion about sentiment, what we continue to hear from our plan sponsors is that their top priority, as well as their biggest challenge, is talent acquisition, talent retention. So they're constantly looking for ways that they can leverage both their benefits platform as well as their retirement plan design as part of their overall talent strategy. So a couple of examples of that we called out in Q2. Number one, we're seeing more and more companies really take a look at student debt assistance as a way to attract workers, specifically younger workers, as part of their overall talent strategy. So we've got some data points that we're going to share on that in a little bit. In addition, when it comes to plan design, we found that more and more plans are increasing the default rate for employees that are automatically enrolled. As we'll discuss in a minute, growing number of plans offering auto enrollment and automatically enrolling new employees, steadily ticking up that default contribution rate really helps those auto-enrolled employees get off on the right foot. So in addition to that, we are going to be highlighting some of our 401k metrics, or I should say retirement saving metrics, so specifically average account balances. The good news is in Q3, we had our third consecutive quarter of increasing account balances. We saw an increase across just about every group that we analyzed, but specifically called out Gen Z workers. Year over year, they saw a 66% increase in their average balance. And as we'll discuss in a few minutes, we continue to see a lot of really positive savings behaviors for Gen Z workers. In addition, in terms of kind of what market dynamics that we want to analyze and how plan sponsors and participants reacted, we have guidance that we provide at Fidelity when people ask about how they should react in terms of market volatility. We like to call it staying the course. Basically, don't make changes to your long-term retirement savings strategy based on short-term market events. 9 times out of 10, we're talking about instances where the market goes down. However, you may recall in Q2, we had, I believe, 13 days in a row where the market swung up and finished up for the day. That prompted a lot of calls to us. Hey, Fidelity, what should people be doing to take advantage of this market rally? How should they be managing their 401k? So again, this was an opportunity for us to apply our stay the course messaging and respond with, they shouldn't do anything. They should continue to take a long-term approach to the retirement savings strategy and not make changes based on short-term market events. And in this instance, in Q2, it's the market swinging up. So we've got some data points that we're going to show that illustrated how people did stay the course in Q2. And then the last highlight we wanted to call out, as we all know, retirement income is really becoming an increasingly popular topic. So what we're starting to do is we're starting to look at people age 55 plus, really kind of at or near that retirement age, and highlighting some of the metrics that we noticed among that age group as a possible indication of what we're seeing, at least on the surface when it comes to retirement income and retirement income strategies. So those are the highlights. Why don't we go ahead and jump into the analysis for Q2? So let's start with student debt. As I mentioned, this continues to become an increasingly popular topic when it comes to talent management strategies, especially when it comes to attracting and retaining younger workers. And so from a participant perspective, we highlighted some data from recent Fidelity research that found that 86% of young workers would commit to 5 years, commit to their employer for 5 years if their employer helped pay off their student debt. We thought this was pretty significant for a couple of reasons. Number one, 86% is a very healthy percentage of workers who would agree to almost anything. So the fact that they're really focusing on student debt is an indicator of how important this is to a lot of young workers. The second part of that, though, committing for 5 years. If you're a talent manager or an HR director, and you can kind of make a change to your benefits platform that could potentially lock up your employees for 5 years, definitely something we thought that our community would want to take a look at. On the right side, we saw that while employees are really expressing a lot of interest in student debt help, employers are starting to get the message as well. So we borrowed some data from our partners over at eBree and found that more than half of employers were already offering some sort of student debt relief, whether that's guidance education, whether that's help with repayments. They're either offering it now or they intend to do so in the next 1 to 2 years. So student debt, obviously a very hot topic, continues to be as the discussion about student debt repayments starts to kick in. So this is a topic that we're definitely going to be keeping an eye on as we go forward in terms of a benefit that can really have an impact on a talent strategy. So now moving to some of our savings data points for Q2. This is a chart that we put out each quarter, and it highlights the average 401k and 403b balances. As I mentioned, very healthy in Q2, third consecutive quarter of increasing balances. As you can see in the upper right there, year over year, very healthy increases for just about every generation, which is great. But what I really like about this slide is that the total savings rate is also increasing, which is an indicator more of participant behavior. So the average balances obviously is great, but there's a lot of different factors that contribute to that. The savings rate is a little bit more indicative of what workers are doing. So as you can see, a lot of very positive numbers in terms of total savings rates. I might add that total savings rates is where we add the employee contribution rate as well as the employer deferral rate, either profit sharing or match. Fidelity recommends a 15% savings rate, which includes, again, employee plus employer contributions. So as you can see, a lot of these numbers really getting close to or at that 15% rate. And again, going back to our discussion about Gen Z and some of their positive savings behaviors, the fact that they're saving 10.5% in their 401k, very, very encouraging. I want to remind you, Gen Z, they're 26 and under. The oldest Gen Z workers are 26 years old. So these are people in their early 20s, only a couple of years out of college. The fact that they're putting away 10.5% for retirement already at this stage, again, really, really good news. We're going to keep an eye on that. We're going to see what happens to that number as they get older and as they start saving for houses and getting married, having kids. But for right now, 10.5% for someone in the early 20s, really, really good news and off on the right foot. So continuing our discussion about average balances, we'll often get questions like, okay, Fidelity, but do you really think $112,000 is enough for people to retire on? We're not saying that. That, again, is the point in time. There's a lot of different factors that go into that. There's people coming onto the platform, leaving the platform, different generations and whatnot. So what we started to do a few years ago is we started to look at what we call long-term savers, people who had been in there with the same employer, the same plan for 5, 10, or 15 years. The reason we focus on these participants being with the same employer, same plan, means they get likely getting the same match over that period of time, as well as the same investment lineup. So if you look at some of these numbers, very positive, and again, really support our stay the course messaging. If you look at the 15-year continuous, look at boomers, that dark green bar, just under $500,000 for boomers who have been in their plan for 15 years straight, really encouraging. And then if you look at the gender side of things on the right side of the slide, 15-year continuous males, just over $500,800 as the average for that group. So this is really indicative, really supports our stay the course messaging, because this shows when you take a long-term approach and you steadily contribute to your 401k, over time, you're going to see those balances increase. I do want to call out one thing on this chart. We are very much aware of the fact that the dark blue bars are higher than the light blue bars. This is something that is not only of a focus for our group, but a focus for Fidelity overall. And we are definitely taking steps to focus on improving these numbers and hopefully seeing the dark blue bar and the light blue bar, eventually the gap start to close between those two. So that is a snapshot of some of the account balance and savings information that we've seen on the participant side. So now we can go to some data points on the plan design side. What we've done, we have a lot of plan sponsors who they want to know what the rest of the industry is doing. They want to make sure that they're keeping up with the Joneses and that they're offering the types of services with their plan that other companies are offering. Again, in a lot of instances, this comes back to a talent acquisition strategy. So in this slide, we really call out some of the more popular plan design options. So first and foremost, auto enrollment, again, really becoming popular, as you can see, has increased steadily over the past 5 years. Almost 40% of our plans offer auto enrollment. But more importantly, if you look at the second line there, the average default contribution rate, still the overall average, I should say that the average has kicked up to a record of 4.1%, which is great. But if you look at the third line, we also look at people who, plans, I should say, that offer a default contribution rate of 5% or higher. And that has steadily increased as well. It's up to almost 40% of the plans. So while we're seeing more and more plans, the default contribution rate was at 3% for a long time. It's slowly ticking up, but we're also seeing more and more plans go beyond that and offering a default contribution rate at 5% or higher. So that's going to get those auto-enrolled employees off on a strong foot as well. As part of the auto story is default to target a target date fund, up to 93.9% of our plans that default to a target date fund, which really will help a lot of those employees make sure their asset allocation is on track. And then we're seeing more and more plans adopt what is our most popular company match formula. To give you some background, this match, it's based on a 5% contribution rate. It's dollar for dollar up to the first 3%, 50 cents on the dollar for the next two. So we're steadily getting towards almost half of our plans offering that company match formula. We're also seeing, again, going back to our stay the course messaging, what will tell a lot of employees if they're concerned and they have anxiety about either, the markets up and down or other economic factors, will say, hey, there are professionally managed options for you. There's a target date fund if you're not already in one of those, but there's also a managed account. So we're seeing a growing percentage of our plans offer a managed account option. It's up to 41%, which again will just give those employees who are looking for some sort of professional help with their asset management another option in addition to target date funds. And then going back to our discussion about talent acquisition, the percentage of plans that are offering Roth option, which historically is very popular among younger workers, up above 80% now. Up from 66.2 5 years ago. So Roth options on 401k plans becoming very popular. So that's a little bit about plan design. Now going back to our conversation about stay the course, people will ask, well, how do you tell if people are staying the course? What do you look at? There's two main factors that we look at when we examine whether or not someone is staying the course or not. One is their contribution rate. They change their contribution rate. The other is their asset allocation. Did they make any changes to their asset allocation? As you can see, we took a look at our 401k platform, 403b platform. Far left, the percentages of workers who did not change their contribution rate, 86% left their contribution rate on the 401k side, 89% of our 403b participants. And then in terms of asset allocation, the numbers were even stronger. 95% of 401k savers did not touch their allocation in Q2, 96% of participants on the 403b side. Now, the last set of, on the far right, the bar chart there, again, going back to what contributes to that. Hopefully people are getting the message that they shouldn't be making changes to their long-term saving strategy based on short-term market events. But what is we're thinking helps that is the growing number of workers who have all of their savings in a target date fund. We're up to 61% of participants in the 401k side, 69% on the 403b side. So very encouraging to see that despite the market's upswing and maybe the temptation to try and take advantage of the market's rally, the vast majority of our participants on our platform really stayed the course throughout Q2. So now taking a look at something we call our 401k millionaires. This is something we thought would just be of interest to this group based on your clientele. But this is a data point that emerged a couple of years ago. It's not something that we necessarily proactively share. It's a very small percentage of our platform. But for whatever reason, that millionaire number really across our society just really has taken hold, and it's something that generates a lot of interest. So we do provide some background on the number of millionaires, number of people, and these are people that have $1 million in their 401k as of June 30th, 2023. But in addition to that, we'll take the opportunity to say, here's some characteristics of those people. And so again, 378,000 people had $1 million or more in their 401k. That was up from about 340,000 last quarter, which is great. Still a very small percentage of our platform, but it's nice to see that number increasing. But here's some of the characteristics that we call out. Average age is 59. So these are people that have been at it a long time. Okay, these are people that really are probably good examples of staying the course. If you think of the average 59-year-old and what they've seen over the past, several years, the average tenure is about 26, 27 years. I mean, that goes back to the mid 90s. So they saw the rise and fall of the dot-com. They saw 9/11. They lived through the financial downturn. They've lived through flash crashes. They've lived through a global pandemic. And they're really an example of when you stay the course through all of that, eventually you're going to start seeing some positive impact on your overall balance. Their contribution rate, very healthy savers, which allows them to take a healthy advantage of their company match. About half are leveraging catch-up contributions because they're age 50 or older. And they're also not afraid of equities. Still about 3/4 of their portfolio on their 401k is in equities. So that allows them to take advantage of growth opportunities when they present themselves. So we try to share that, not only the number of 401k millionaires, but also the characteristics, just to give people a sense of how they got there. And these were not a bunch of 30-year-olds that found some hot stock, that they heard about and all of a sudden boosted their 401k up to north of $1 million. So that's the 401k millionaires. So now a quick look at some characteristics for some of our participants who are 55 plus. Again, this speaks to the growing conversation around retirement income and how people are managing their savings in retirement. So the first thing that we took a look at is equity allocation for people who are 55 plus. So as you can see, we did see a fairly healthy percentage of the participants in these age groups that had probably a little bit more equity than would be recommended. And just a quick aside, the yardstick we use is our Fidelity Freedom Funds. And so the equity allocation in our freedom funds, we would take a look at that and then see how the allocation compared for folks in these groups. So could be a very valid reason why a lot of these folks have more equity than recommended, but it's just something that we really thought it would be beneficial to highlight to our external audiences, especially if you look at the folks age 70 plus. Almost half of those participants probably a little bit more equity than we would necessarily recommend. Again, could be a very completely valid reason why they have that, but it was just something we thought was worth highlighting and thought that this group would definitely benefit from learning about. And then the other data point that we took a look at was whether or not these groups are using a target date fund. And as you can see, even if they may be using it, there's a pretty healthy percentage in all these age groups of participants who don't have all of their savings in a target date fund. So could be an opportunity there to help them in terms of shifting from a more of a do-it-yourself type of investment mindset to what we like to call a do-it-for-me mindset, where you get some professional help with your asset allocation. So this is probably the first kind of our first foray into really looking at this 55 plus group. I would imagine in the coming quarters, in the coming years, we're going to be looking at this group a little bit more closely, because it is becoming a little bit more of a popular conversation in terms of how to help workers as they reach retirement age manage their savings and convert it into a retirement income strategy, moving from the accumulation stage to the decumulation stage. So that is our 55 plus. Now I want to share an industry snapshot. What we found over the past few years is that companies want to know, not only do they want to know what the popular plan design and various features are across the retirement landscape, but they want to know what plans are doing in their industry. So the airlines want to know what the airlines are doing. The manufacturing companies want to know what manufacturing are doing. And so what we did is we can separate some of our 401k data by industry. And what we'll do each quarter is kind of go through and highlight some the various trends, and whether it be plan design or participant behavior that could be of interest. So if you look at employer contribution rate, the petrochemical and pharmaceutical industry is very strong, but we also saw that pharmaceutical is really strong in terms of offering a Roth option, which might not have been something that people would have initially guessed. If you look at the percentage of workers automatically enrolled, auto enrollment makes total sense for retail trade because there is a lot of fluidity in that space, but construction never would have thought necessarily that the construction space would have auto enrollment, as well as doctors, healthcare physicians. 63.8% of workers are automatically enrolled. And then if you look at the 100% target date fund, again, retail trade makes sense because they have such a high percentage of workers who are automatically enrolled. Same with construction, but again, looks like doctors really embrace target date funds, which again may not be common knowledge or what people would necessarily think first and foremost, but more than 2/3 of healthcare physicians have all of their savings in a target date fund. So this is something that we try to do each quarter as well, just to give our plans in specific industries an idea of what other plans, what their industry looks like in terms of plan design, participant behavior. So then lastly, we just had a couple of slides to go over some of the IRA trends. Again, we understand that these are not workplace savings accounts, but because we do have a lot of participants who save in both their workplace savings account as well as their an IRA, we thought this data would be helpful just to kind of help provide a more complete picture of what the retirement savings space looks like. So first and foremost, we're looking at balances. Again, very healthy growth in the overall IRA space. We're up to 113,800 as the average. So, and when we calculate these averages, it includes everyone. It includes everyone, people who have been saving for quite some time in our IRA, as well as people who have possibly just opened one up. So the fact that the average is trending up is really, really encouraging. And then in the upper right, we called out the fact that female millennials really have shown significant growth in terms of opening IRAs, an increase of 22% over the last year from Q2 2022. So that is a quick look at the assets, or I'm sorry, the balances, and then contributions. We do call this out. Granted, as many of us know, IRA contributions not automatically deducted from your paycheck. Definitely a bit of a seasonal aspect to IRA contributions. We see a lot in Q1 as people look to make those contributions for tax purposes. Overall contributions trending down just a little bit, nothing drastic, but again, we are seeing when we look at where the contributions are going, Roth IRAs are very popular. Almost 60% of all contributions went into a Roth IRA, especially true among millennials. And so this just reinforces the thought that Roth options definitely popular. for our younger workers. And so it could be something, if you are part of your talent strategy is to attract younger workers, Roth option might be something that you would want to consider for your plan.